Well, here's a question. When might a debt default actually be good for investors? The answer, when investors are in stocks and not bonds. At least that is what some recent history suggests. All right, first, to the Athenian pain, right? The Greek ASE stock market index is down nearly 30% since February, and it has lost about 80% of its value going back to the highs of 2007. Michelle's talked about it. We've talked about it. We know what a horror show the stock market in Greece has been. But is that a reason to buy Greek stocks? Well, let us use history to make the case, all right? First off, I want to focus on Russia. Now, Russia said that it was defaulting on its debt on August 17th, 1998, right, which is right about here. Now, this is a chart of the Russian RTS stock index from 1997 to 2002, okay? So you can see that ahead of that default, I mean, pretty much everybody and their mother knew that it was coming. That's about where the actual default happened. Then look what happened. Over the next couple of years, the Russian RTX index took off. Sure, didn't get back in a couple of years to where it was, although it's much higher than that now, but it came very nicely off its lows. Next up, I want to look at Argentina, okay? The Merval index. When Argentina defaulted back in 2001, the benchmark Merval index was all the way down, well, it was right about here, which is about the level of 200, okay, on the Merval, right? Well, holy smokes, they defaulted here, and look what happened. Over the next 2 to 3 years, their Merval index took off, and in fact, was back to a level, now it's at 3,000. Do the math on that. 200, a default, then to 3,000 over a number of years. And finally, Indonesia. Indonesia, of course, also suffering a massive financial crisis and default all through the Asian crisis of 1998. The Jakarta JCI index absolutely crushed that year. But in local currency terms, the market recovered all of what it had lost by the year 2000. So you can see that. Boom, back up for Jakarta. Now, that is the key. And before you go out and start buying up Greek stocks because equity markets tend to rise, or at least recently when they default, the last part I mentioned about Indonesia is the huge variable, right? And that is local currency. Those gains were in local currency terms. Those economies we talked about had the ability to devalue their currency. Greece, unless, Mandy, they go back to the drachma, cannot do that because they're on the euro. So how will the stock market ultimately react if Greece defaults? We don't know. But the stock markets of Indonesia, Russia, Argentina, actually of South Korea and a couple of others, just didn't have all the time to get to them, say that when you default on debt, you got more money to invest and stock markets tend to rise. All right, let us bring in Philip Silverman from Kingsview Capital and Josh Brown from Fusion Analytics. Philip, I'm just going on history, not advocating. Obviously, it's not my job to buy Greece stocks. But what do you make about what we said here? Could Greece be the same way?
I mean, it's possible. I think, when you've got defaults like this, you get to reset and build off a good base. A bankruptcy or restructuring is not necessarily always a bad thing. It allows you to get rid of the junk and move forward. Now, I wouldn't go out and buy any Greek stock, but typically the baby gets thrown out with the bathwater here. So there are some companies that you may be able to find that have some solid businesses that you could profit from.
Like what?
Well, I'm not a Greek, specifically a specialist in Greek stocks, so I don't have any names to give you.
Okay. But nonetheless, just a second, guys. I mean, we haven't defaulted yet. And Josh, I was reading your notes, and you were saying, you've gone long volatility, long the US dollar index, and double short the Nasdaq and the S&P. It sounds like you are very negative on the Eurozone situation, and yet the news that we're getting out of Greece at the moment seems as if we're working towards a deal. Are you still so negative?
Hi, Mandy. This has been going on for 2 years. There's going to be a deal, and then in 3 weeks, another leg down, and then another deal. And I think that concept of let's buy Greek stocks because look at this and that, the other situation, it's one of the most dangerous things I've ever heard in my life.
Josh. Yeah. Okay, since I'm the one that did it, I'm not saying buy Greek stocks.
I know you're not. I'm saying the concept. Sure.
What's the concept? I was looking at history that in Russia, Indonesia, South Korea, and others, when they defaulted, the stock markets took off. I'm doing nothing other than looking at the charts and wondering if the same thing can happen.
Fair. So let's bring some context in. Look at the global economy, what was happening during that 2002 period of time when most of those rallies started. There's a lot more to the story than just the facts on the ground in those countries. And then I think what's really key here is This is a contagion story. I'm not going to say this is Lehman, but let's keep in mind, if there is some kind of a haircut in Greek bonds, which undoubtedly, I think, has to be part of the ultimate solution, maybe not this weekend, but in 5 weekends or 10 weekends, if there's some kind of contagion situation, what you're basically talking about is a re-rating of Portuguese bonds, Italian bonds, Spanish bonds.
Okay.
This doesn't end because they swore someone in this weekend.
Well, hopefully they're trying to ring fence all of the others. But nonetheless, Josh, how do we play the market right now? And I think we should also really mention one of the other big stories is how much crude prices have come down, which is obviously a bit of a tax cut for everybody. Is this something we should also be playing, Josh?
We're basically looking at this as a situation where June is a terrible month in general for stocks. It's the third to worst for the Dow, second to worst for the S&P of the year. It's just not a great time to be getting aggressive at all. For more aggressive clients, we've actually been going long volatility. We've been involved in the double dollar, and we're actually double short a couple of the indexes right now as a hedge against long positions. So we are interested in some dividend-paying names, but we're just not out there looking for ideas. I think that the bottom line, investors need to remember their ABCs in a time like this.
Josh, I hear you, but Philip, I want to ask you, and I hear his point about contagion. Our viewers know I've been negative on Greece and Europe for a long, long time. Yeah. But Philip, in 1998, right, we had the Asian currency crisis. That was a contagion too. Everybody I talked to in 98, when I was doing the same thing I'm doing now, thought the world was going to end. But if you were a buyer of some of those stocks, South Korea, Indonesia, you've become wealthy.
Absolutely. I mean, time and time again, the best time to make investments is when it's scariest. Now, I'm not specifically saying we're at that time with Greece yet, but there are certainly a lot of problems out there. And when no one wants to go there and everyone's afraid, that's when the deals show up. At the end of the day, it's all about the price you pay for something. Now, the Europe situation is a mess. And you've got an interesting story here with macro-wise, there's just lots and lots of bad news. But there are some places where you can get some good deals. And U.S. corporations are actually looking quite good right now.
Yeah.
And there are some that we think have solid balance sheets. They're trading at decent valuations.
Right.
For example, in Intel, large cap blue chip tech is something that's pretty beat up.
Absolutely. We've got to leave it there. But Philip and Josh, thank you very much for joining us today.